What's up, everyone? It's Karthik and Moneyvest. Welcome on board for our Market Open live stream on Thursday here, as we are seeing the markets gap up incredibly well. Are we back? Seems like we are indeed back. QQQs are jumping. We are up a little bit over 2% pre-market. Lots of momentum coming in. S&P 500 up over 1.5%. Once again, we're seeing very nice momentum coming in from the markets here. Nvidia, of course, stealing the show, up over 5% right now. And we've got BMNR pushing up over 4%. We got Ethereum, Bitcoin are also pushing higher on the day so far. And we've got volatility here with a 16% crush. Once again, we're back under 20 on the volatility. Hope you all are doing great. Jobs numbers came out for the month of September, so we can break those down as well. But unemployment rate did indeed tick higher to 4.4%. So that's where we are with private payrolls jumping over 119,000 jobs added in the month of September. And the unemployment rate was up to 4.4%. So that is indeed a little bit higher than where the consensus was. Consensus was at 4.3%, but we came in at 4.4%. But that is actually a good thing, because for the market, that means more bias or more leaning towards a potential rate cut in December, as well as unemployment continues to tick higher. 119,000 jobs added, 4.4% is the unemployment rate. That's where we are. And that is going to increase the probabilities of a rate cut moving forward. So good morning. Here we are for the market update. Mega lift. Oh my God, we are so back. Never doubted. And yeah, that is quite the sentiment right now. We are so back. Am I right? Great speech you gave us on your last video around the 8-minute mark as a newer investor. Thank you so much, Andrew. I really appreciate that. I can't remember what I said at the 8-minute mark. Maybe we can listen on it together. But I think it was something to do with newer investors having to go through this for the first time. And of course, we have gone through this over and over again. I can tell you that it's not the first time, and it's certainly not the last time either. We're going to see corrections. We're going to see pullbacks. Volatility is going to spike again. But we need to always be prepared and take advantage of those opportunities, because, I know it can definitely scare some of the newer investors, because, if you're investing for the first time and you see your markets go down and your portfolio go down, that can be pretty stressful. I totally understand. I totally get it. But the worst thing you can do, obviously, is quit when times get tough. It's, you got to trust the process, believe in what you have, right? So confidently holding on to what you have and dollar cost averaging when the opportunity presents itself, and that's the best time to actually buy. Yes, we blew past the 50 EMA for sure. We're trading back above that white line, which is a great sign for us to recapture that moving average here. But once again, I do want to point out that we are still, I would say, within the context of a downtrend. So yes, the 50 EMA was the first hurdle, which pre-market it does look like we are gapping higher, which is very, very good. But we also do need to take out some of these resistance levels. For S&P is going to be 685. So that's going to be the level to watch very closely as we progress today, tomorrow, next week. And for QQQs, that number is going to be all the way up to 625. So that is going to be the level for QQQs. So that's where we are. Meta and Amazon still seem very good value. What is your opinion? I agree. I think Meta is a better value for money. And then Amazon also has been selling off quite aggressively. So I think Amazon makes for a great dollar cost averaging opportunity down here in the 210s and 211s. And Meta is already at my light buy. So my light buy is at 590. My heavy buy is at 550. So those are the two levels that I've been watching. And that's also been mentioned in the shopping list. And then Amazon, like I said, 210, 211 are going to be pretty strong support levels there. I see your happy face. So Altaf, always happy, right? You always got to be smiling, having a good time, positive, happy about the markets, and only then you can feel excited about every day. So, you're either excited about opportunities or you're excited about gains. Bottom line is you should feel excited and happy and upbeat about the markets every single day. And if you love what you do, that's even better. And so, yeah, here to share the positivity and the smiles to hopefully brighten up everybody's day as we are rocketing back higher pre-market. So very, very nice to see that. Good thing I rolled or closed a lot of my calls. I ended up closing out a lot of the calls during this entire sell-off. And the idea would be for Palantir, for Tesla to maybe open new calls and collect some more premiums for those positions. So we'll look into that as well. SoFi and Oscar, I've started trading options on both. Thanks for your help. That's great. So SoFi has also been incredibly volatile. It is gapping up over 3.7%. So this right here was that support that we were watching for SoFi right around $24, $25. And then Oscar also has been selling off aggressively. It's actually right at that support once again. So if you look at Oscar's overall chart, if you come over to the weekly time frame, it's been bouncing off of that level every single time. So this right here is the box, within which it's been trading, right? So we got a resistance right about there, and we've got a very strong support right about here, and it's bounced off of that level every single time. Is it going to happen right now? Obviously, nobody knows, but yes, the risk reward is very good here at these levels for Oscar. So selling puts and even straight up looking at buying opportunities and swing trading opportunities seems to be a pretty lucrative idea. Anything under 1350 is where that stop loss would be for Oscar. So that's where we are with this stock. Yes, rate cut probability is going higher, and that's exactly why the markets are a bit more bullish, even more so than where we were just like, let's say, 30 minutes ago. Because of the unemployment rate ticking higher. So if I bring you over to BLS's website, and if you go over to subjects, national unemployment rate, and this is the chart, and if you zoom in, you'll notice that we have hit up 4.4%. This is the highest level since October 2021. So, obviously there's not going to be a lot of conversations around it, but we just hit an unemployment level, which is a 4-year high, right? So in over 4 years, this is the highest unemployment's been at 4.4%. That's where we are for September 2025. So clearly, yes, unemployment is indeed ticking higher. There is clearly a substantial decline in the number of people that are actually working. And one more thing that I really want to point to is the civilian unemployment as well. And that number is rocketing higher. I mean, it is now sitting at over 7.6 million. So if I bring over my unemployment spreadsheet, which, I have broken down in my previous videos. So this is the unemployment spreadsheet. And what we're going to do is we're going to update this number right here, unemployment, 7.603. So 7.603 here. So that's where we are. And I also have to update the number for JOLS, right? So for actual job openings, because this number right now is sitting at 4.472%. So that's where we are. And then JOLS numbers actually were canceled or did not come out. They were supposed to come out today. I think they revised those numbers and we did not see that. Let me just bring up the revised schedule for Bureau of Labor Statistics. So this right here. So JOLS numbers were canceled right here. So they did not come out. They were supposed to come out earlier in the month of November, November 4th, and they were canceled. The JOLS report here, so BLS will not publish September JOLS numbers. Data from the job openings and labor turnover survey for September 2025 will be published with the October 2025 data. So yeah, we did not get those numbers, so I can't really update that. But the ratio is less than 1. So labor market clearly weakening. We are seeing unemployment go up to 4.4%. And as a result, there is a higher bias towards cutting interest rates, especially after today's report. But again, this is a super lagging report. October is going to be canceled altogether. So we're just not going to get that October number. So BLS will not publish an October 2025 employment situation news release. I really wonder what these charts are going to look like. I mean, if there's not going to be any October numbers, are they just going to go from like September to like November? Are we just going to skip October 2025? That's such a gap in the overall data. Like it's just weird that we'll be jumping a whole month and not really have any idea. Like imagine there's so many models, there's so many spreadsheets. There are even my spreadsheet, like for October, I will not be able to put anything in there. to better understand where the moving averages are, where the last 6 months or 12 months worth of unemployment numbers are, and it's gonna throw things off a little bit. It'll be a marginal change, but yeah, Mike says that it'll eventually be a gap fill for unemployment. Imagine we gap up on unemployment. We're doing technical analysis on unemployment rate. Like, come on, this is just so nerdy. But yeah, we are on a strong uptrend, you guys. Like, we are actually making higher highs and higher lows for unemployment as well. So just got to be careful. It is in a very strong uptrend. But yeah, so that's where we are. We're not going to get the October numbers. Joel's numbers we also did not get. So all we have to work with is whatever data we do have. And that is not a lot, at least not right now. So Caddy, throw some numbers in for October. Your guess is as good as BLS. It's kind of hard to say, because unemployment rate, I'll have to go back and calculate, because we won't, so it's not just about the unemployed persons and how much that went up. It's also about participating population, total eligible workers, the participation rate. Like, for example, in today's report, we learned the participation rate is around 62.4%, right? So that's the actual participation rate. And that is off from the previous month of 63.9. So that's a pretty substantial difference, right? 1.5%. That's a lot of people. 1.5% on a population of 170 million is how many people we're talking? Is it? Yeah, that's 255,000 people, right? So that's a 250,000 people so if I were to put a participation rate and it's off by 1.5%, just as an estimate for October, I would be off by 250,000 people. If that's not the reality, right? So we not getting the data would be worse if I were to just put some numbers in and try to look at what the actual numbers are, because that would be more disastrous. It could be off by more than if I were to just not consider them at all. So yeah, that's where we are with those numbers. We're not going to get them. We just have to make our peace with it. Yeah, MacD, great point. Try to think of your investment account like a professional team. Buy good athletes. And I would argue, think of it as an NBA team as opposed to an NFL team, if you know what I mean. Fewer, the better. You don't need 40 people in your squad. We only need like 7 or 9 really good players. And so I agree with that. Think of it as a sports team where you want the highest quality athletes. And yeah, so that's a good way to put it. So we're likely at 4.5%. I would guess at 4.5%. So 4.5%. I would say, yeah, we're somewhere in the 4.4 to 4.5% for unemployment. George, welcome. Hello from Athens. I've subscribed but can't see any options alerts or stock alerts. Pino, so you will be able to see that on the options or investing alerts. So there should be there. All of them. So if I were to just quickly show you exactly where to find them, if you're in our Discord, you will be able to see that on the left panel. So if you go up a little bit, that's where the alerts are going to be: investing alerts and options alerts. So those are two of mine. Trade alerts, some of our other more experienced members, Dave, Kevin, they're sharing their ideas, trade ideas. Again, we're sharing more and more analysis there. But these are all the alerts with the portfolio breakdowns, week number 46. All of that will be accessed over here. So I also did share the actual numbers. So unemployment rate jumping to 4.4, 119,000 jobs added in September, and unemployment ticks up to 4.4%. So that's where we are. Okay. All right, let's break down some stocks. We're going to talk about some companies, some stocks here. VIX at 19, so we are certainly coming down. We're in an upward trend where it comes to unemployment because Gen Z likes socialism and agentic AI starts doing tedious work like analyzing documents, images, contracting the clients with answers. So I do agree with the whole premise that I think there's going to be a time where unemployment goes up and productivity continues to go up, because a lot of these companies, they've figured out, the AI circular loop where you can have a lot of the entry level positions be done by AI around the clock, more efficiently and cheaply. That's the most important thing. It's very, very cheap. It's like significantly cheaper to actually train an AI model than to hire a fresh graduate, right? So that's the big discrepancy there. But eventually, what that's going to lead to is, like I said, higher levels of potential unemployment and higher levels of productivity and growth as well. So I do think the Federal Reserve, with the rise of AI, is going to have to change their dual mandate over the long term, because unemployment, it's going to be hard to control unemployment just by lowering interest rates, because there's a possibility that in the past what we've seen is when interest rates go down, the companies have cheap access to capital. And where do they use that capital? Where do these companies actually use capital? If I were to ask you, when the Federal Reserve starts to lower interest rates to try to support, the economy, because the economy is weakening, unemployment is going up, and so they decide to lower interest rates because the companies can borrow money cheaply, where do they spend this money? What is the Federal Reserve hoping these companies spend their money on? Why is it that they lower interest rates? What are they trying to do? They're trying to spur the economy. They're trying to create more liquidity, more credit in the system, so that what exactly happens? What happens basically? Need to invest in higher education to help with AI job creation. Yeah, so a lot of companies do end up spending on hiring, right? Because they can borrow more money cheaply and they can hire more people to help fuel that growth and that business. But I believe that moving forward, it's possible that a lot of these companies... I just got to take a quick call, you guys. I was expecting a very important call. Just give me 1 second. I'll be right back, okay? I'm so sorry about that. All right, sorry about that, you guys. So as we were talking, so coming back to the question around so companies, quantitative easing, of course, a lot of interest rates, when they go down, a lot of companies do end up hiring. But moving forward, as I was saying, my opinion is that a lot of these companies will end up using a lot of that cheaper capital and the liquidity that the Federal Reserve is injecting into the economy to build data centers, right? To do a lot of these partnerships with artificial intelligence companies and to essentially make themselves more efficient and do a lot of the work more cheaply, right? Because of AI. And so what that's going to do is that's not going to help solve the problem, right? So unemployment could unfortunately still be an issue that the Federal Reserve is trying to fix by lowering interest rates, but it may not get fixed. Instead, if only, it could actually get worse as companies have access to more capital. And so I think I mentioned this in a few of my videos in the past as well, that it's possible that a lot of these companies, obviously focus on building AI infrastructure as opposed to actually using that capital to hire more people or train more people. And so we are starting to see a little bit of a shift in the overall structure, where originally used to be like a more triangle fashion. You've got the entry level employees at the very bottom. You got the middle managers, you got the top C-levels and executives at the very top. And now what we're seeing is a little bit more of a diamond shape where you've got the entry level at the very bottom, and it's a narrower because it's a diamond shape. It's like a more of a rectangular shape, angled. So you've got lower number of entry-level employees, and then you've got a lot of middle managers and more specialized managers, and then at the very top it's the same, where you have the C-level and the executives. So that, in my opinion, could change how the Federal Reserve operates because we're entering into this new era of AI, and so the Federal Reserve might have its work cut out for them in very different ways. So then I think it's possible that a lot of government subsidies and government programs are launched for companies to actually hire, to try to force them to hire, as opposed to just lowering interest rates to encourage them that way. So Kostov says, we only get senior engineers after junior engineers get experience with agentic AI. If we don't hire enough junior engineers, how are we going to get senior engineers in the future? That's true. I mean, that is also very true because you have to go through that experience to get to that level in the first place. So high level like training and higher education, of course, AI are going to be very, very important. Essentially, what we're going through as an entire employee workforce is an upgrade cycle, is what I would like to call it, is because we went through that 20 years ago when the internet was introduced, and now also we're going through, I think, a big upgrade cycle overall. Okay, all right. SoFi. So let's just go over some stocks. Any questions? Just let me know. More than happy to help here. And let's take a look here. Please share your thoughts on this. As a starting position, I will say that I'm invested in Nvidia. Cost base is $95, so I'm holding for quite a long time already. I like the numbers they printed, but there is so much spending on AI infra. I hear that the capex is going into trillions of dollars, but where is the revenue going to come from? Who is going to pay for AI usage, and where do you see this usage? So that's a great question. It's a very loaded question. From an Nvidia standpoint, I'm not as concerned about Nvidia as I am on hyperscalers and what these companies can actually, because at the end of the day, like what Nvidia is doing, right, is selling you the shovel to mine gold, right? That's what they're selling you. They're selling you the GPUs to build the data centers, which can then be used by these hyperscalers to make money, right? Whether they are building their own applications, whether they are renting out this space to other companies, whatever it is, it's their job to actually generate revenue and make a good return on their investment. What Nvidia is doing is that, okay, you give us the money, we'll give you the chips, go ahead and run with it, make your data centers, and see how profitable you can be. So Nvidia is, in my personal opinion, is a lot less concerning than the hyperscalers. Now, the success of hyperscalers is what makes Nvidia successful, right? Because if those hyperscalers are not successful, they're not going to buy the chips, and Nvidia's business also, goes down. So yes, Nvidia's success is also contingent on the hyperscalers, but if the AI is the new wave and Nvidia continues to sell because they're actually realizing a lot of the revenue and profit today, whereas the hyperscalers are building, the future, which nobody knows, but that future could be 10x from what we have right now, or it could be nothing, right? Nobody really knows how big this thing is going to be, or how lucrative and how attractive in terms of returns this investments are going to be. That's why if you look at hyperscalers, Meta is trading very differently than Google. Google is trading very differently than Microsoft. Microsoft is trading very differently than Amazon. So every company is being analyzed on its own merits and how much of an ROI is each company going to see with the capex that they have committed to spending in AI infrastructure. And that's one of the reasons why Meta's been selling off, because analysts on Wall Street believe that Meta's ROI is not going to be that much. They're spending billions of dollars in building an AI infrastructure, but just to use that AI infrastructure and those data centers for more specific AI, ad targeting is not going to substantially move the needle. Whereas Google, Microsoft, AWS building data centers to provide other companies with AI compute and cloud services is a huge revenue driver. So you can actually see and model in that level of return. But with Meta, with some of the other companies, it's kind of marginal. But at some point, the hyperscalers might just not see the revenue coming in, so they will cut capex dramatically because at the end of the day, the AWS, etc., they need to sell their AI infra and earn money. That's true. But right now, we are still seeing the demand surpass supply. Like demand is higher than the supply, which is one of the reasons why there is a shortage of chips and there's a shortage of compute, especially AI compute and GPUs. So if and when we actually get to that equilibrium, where the demand supply matches or the demand, starts to outstrip supply, then, supply starts to outstrip demand and demand is actually lower than where the supply is. That's when we can start to see some tapering and some stabilization in prices, investments, and valuations. But right now, it's the biggest craze. I mean, that's what's happening with a lot of these companies. So, semiconductor bubble is imminent. I don't think that semiconductor, I don't think that chips and semiconductors are in a bubble. To be very honest, like I feel semiconductors and chips are actually one of the safest, in my personal opinion, industries of the future. Why? Because it's not about AI. It's about every piece of hardware, right? Whatever we are going to use in terms of technology doesn't even have to do with AI. Whatever you use, the next generation televisions, the next generation smartphones, the next generation machinery, equipment, the next generation aviation, right? Everything is going to require chips. Everything. It's going to be the brains behind everything. It's always been that way. And so I believe that AI is in a separate, if you want to call it a bubble, but I would say AI is separate. Semiconductors are obviously powering that AI movement, but they're also powering everything else. They're also powering gaming, cybersecurity, all the other digital hardware, technology, like everything else. So it has more broader applications, semiconductor and chips as a whole, and AI is just a subset of what chips can actually do. But chips can do a lot more than just AI. So chips, in my personal opinion, I've been very, very bullish on SMH, and I will continue to be like dollar cost averaging and just keep on buying. Any opportunity I get, SOXL is going to be my go-to. It's like a 3x. It's a lot more volatile. So you can see that it hasn't had a uptrend. It's been more of a tradable opportunity, and it's been one of the best tradable opportunities. But SMH has a much stronger uptrend because it's a non-leveraged actual index ETF. So we'll continue to dollar cost average, even if it does drop, let's say down to those moving averages, 260s, 270s. I think it's going to represent tremendous risk reward for the long term. So SMH is always going to be the top of my portfolio for just dollar cost averaging, and every opportunity I get, like just going to be putting more money into it. But AI as a sector, as a subset within chips, yes, we can analyze and we can look at a lot of different companies, and I would agree with you if you tell me like AI is in a bubble. I would say that it's trading at a very large premium, and there's a lot of companies that are pushing higher on valuations with little to no revenue, only based on ideas and AI next to their name. So I would agree with you there. But chips, semiconductors, I think are not in a bubble. Sanjeev, guys, we are in the early stages of AI. The adoption will take time, but it's important to lay out the foundation. That's exactly what is happening right now. Okay, so let's cover some stocks. I'll take a look at some names here that you guys are putting up that we haven't looked at already. And then we'll just quickly break those down and then go from there. So the underlying fundamentals of S&P 500 remains the same. Only tech is pulling up all sectors. Smart money is selling to retailers very much alike in December 2024, February 2025. We have seen, obviously, institutional funds, sell a lot of these names, sell a lot of these stocks, which is normal. They like to be very tactical and they like to rotate in and out of their positions. But that being said, I think technology has been leading this market over the last 20 plus years, right? It gets over concentrated and then we see some profit taking, then it becomes over concentrated again, and then we see some profit taking. So, it's a very, very famous video of Warren Buffett showing and putting up the top 10 companies from back in the 1970s and 80s, and they were completely different businesses than what we have now. And I'm sure the list of today is going to be very different 20 years from now. We're going to have new companies unless technology continues to adapt at a very, very rapid pace. It's possible that the big seven, the top seven that we have now, may not be the same top seven 20 years from now. It could be something else. It could be Palantir. It could be Hims and Hers. Heck, I don't know what they can do, SoFi or whatever. But it's possible that, these companies continue to evolve, and it's going to be new businesses that rise and come up. Okay, Hims and Hers. So this is going to be the entire technical analysis. We've got a very strong support at $34, $35. We've got a resistance all the way up to as much as 39 to $40 for Hims. And like I said, that is going to be that support level. We're getting a little bit of a bounce back higher, given how oversold we are on the RSI, the MACD, and the L3 banker oscillator here. And resistance is going to be all the way up to as much as $40 for Hims and Hers here. Support level is going to stay up at $34, $35. Coming over to Bitcoin, we're seeing a nice little bounce back up. A little bit of a doji candle right now. So resistance all the way up to as much as 99, close to 100,000, with a very strong support down at $90,000 for Bitcoin. So it has been, of course, in this lower high and lower low pattern of downtrend. And then, of course, volatility down over 17%, back at under 20. How do you see the risk reward for someone starting a new position in semi stocks like Nvidia and Broadcom? Samuel, that's a great question. How do you even evaluate the risk reward ratio for a company, whether that's good or bad? So you brought up a couple different stocks, Broadcom and Nvidia. So first thing is to evaluate the business as a whole and look at the company and in terms of their revenues, future cash flows, future earnings, discounting them back to present value. What is the fair value of the business? There's a whole analysis that we can do. We can do a discounted earnings. We can do discounted cash flows. We can simply discount future sales. So there's a lot of different ways where you can discount the business to present value based on their future cash flows or earnings on 3 years, 5 years, 7 year, 10-year basis, right? Depending on the time horizon, time frame you want to choose. Once you have a fair value, we apply a margin of safety of 10%. So if your fair value for Broadcom, for example, comes up at $300, you want to add another 10% margin of safety, you deduct another $30, and $270 ends up being the fair value, including the margin of safety you want to build there. So $270 ends up being a intrinsic value, right? That's what you think Broadcom should be trading at as a fair value. Anything over that, overvalued. Anything under that, considered undervalued. And you want to buy stuff that's undervalued, and you want to sell what's overvalued. Pretty simple, right? Buy low, sell high. So you want to buy things, buy opportunities, and ideas that are undervalued in the market. Now, given the market environment, given the state of the entire market and stocks, it's possible that there's very few deals to actually purchase, and that's what's happening with Warren Buffett and Berkshire Hathaway. They keep on loading up more and more cash, $400 billion cash pile, because they don't have a lot of opportunities to deploy that cash into, because according to them, they don't have a lot of undervalued opportunities right now. There's not a lot that's trading at a discount or deals out there. And that happens from time to time, but in every kind of bear market, every type of correction, a lot of stocks will indeed sell off. They will come down to our fair values. They will come down to undervalued levels, and that's where the risk reward is significantly better. And so that's how I go about looking at risk reward, and then of course combining it with technical analysis to better understand whether it makes sense or whether we can find better deals. Because everything is going to be an opportunity cost, right? So $1 invested in Broadcom is $1 taken away from investing in something else. So we don't have unlimited capital, right? None of us are Elon Musk. So we're working with limited capital. We have to make sure that whatever opportunities we do choose are the highest quality, have the best risk reward ratios in the market. And there's nothing else we can find that's better than what we're buying. Okay, so what do you think about buying AMD SoFi at this stage? AMD is a bit more on the expensive side. SoFi is okay. It's a little bit more reasonable. Novo Nordisk we have covered in the past in previous live streams. It has been consolidating sideways, resistance back up to this resistance all the way up to $56, $57. And of course, a very strong support down here at $45 for Novo Nordisk. So that's going to be that level to watch. So maybe stocks now. What do you think about MasterCard? So MasterCard has been selling off quite aggressively here. I like Visa better, just because of the market share, the overall fundamentals. MasterCard's also a great company, but I have always preferred Visa over MasterCard, and they've both been selling off, and Visa is actually part of the shopping list as well. So MasterCard also, like I said, great business, great margins, revenue growth, earnings growth, trading in a bit of a downtrend here. So bouncing off of that support at 525, which we have marked out, and resistance all the way up to 549, 550 for MasterCard. So that is the downtrending channel of lower highs and lower lows, and resistance all the way up to 549, 550 for MasterCard. So about 4 or 5 minutes left until market opens, everybody. Hope you all are ready with this market open that's about to fly right now. Stocks are absolutely ripping higher as volatility comes down 17% on the day. And then need your opinion on BMNR, my biggest loser at the moment. Thinking I'm at my fourth buy, the dip in the last month. So, with a lot of these speculative names, always make sure that you only don't bite more than what you can chew, okay? And with these stocks, if it's a brand new position and it's something that you're not 100% confident, you're like, okay, it's a speculative position, it's a crypto position, keep it at a minimum, right? Allocate a percentage of your portfolio. Be like, okay, 2%, 3%, 5% is my play money, and this is what I'm going to put into some of the more volatile, more speculative plays, and BMNR kind of fits that profile. If you let it become a 20%, 30%, 40% position at worst, more than that, and you're losing sleep over it, you're stressing out over it, then that needs to be evaluated, right? Because risk is not something, as I've said before, is not something that you can actually quantify very well, okay? A lot of people misjudge their own appetite for risk and their own appetite for volatility. If I ask you on a scale of 0 to 10, and I ask you like how much of a risk taker you are, 0 being you just do not like to take any risk, you much rather stick your cash under your mattress, and 10 being full-on gambling risk, what's going to be where are you going to put yourself? Some people might say 3, 4, 5, 7, 8. It's going to range from everywhere. But it's still not going to be a number that you can quantify. It's a feeling. It's a feeling that you will feel when your capital is actually at risk. And the best way to calibrate this is through position sizing, is literally through position sizing. It's something that you calibrate over time. If you have 100% of your portfolio in BMNR, you're going to be stuck to the screen tick by tick, watching it every second of every day. If you've got 1% BMNR, you're not going to care. You're going to be like, yeah, whatever. I don't care where it's trading. It's down 9%. It's fine. It's only 1%. It's going to be somewhere in the middle. That's going to dictate how you feel about that position. And that is the true essence of risk calibration, which is a feeling. And everyone has to do that for themselves. Mr. Real High, I'm 9, but good at it. BMNR, stop loss at 5% for me. Yeah, risk management, stop loss is very, very important for these speculative tradable stocks here. If you're good at it, then that's good. If you can manage it, that's great. That's even better. But okay, let's take a few more stocks here. Let's look at them. Trade Desk, we've covered that. It's been selling off aggressively. Support level is going to stay at $39.40. So this right here is going to be that level of support. And of course, a resistance back up to as much as $43, $44 for Trade Desk. So that is going to be that resistance level to watch there. And then finally coming over to Archer Aviation. We'll take a look at that one as well. ACHR. Selling off, very oversold right now. And we've got a support level sitting all the way down to 660 for Archer. All right, everyone. So market's about to open in a couple minutes. Make sure that you drop a like. We're only at 62 likes right now. The ROI needs to be better than that. 447 people watching. 62. 62 is a 13.8% return on our viewership. We need to at least beat the S&P 500. S&P 500 on the year is up 12.4. Okay, we're already beating the S&P 500, but not if you include for the pre-market gains. So get that like count up. Make sure that you drop a like so we can at least get up to over 20 to 30%. Why monetization is off? Live streams, we're gonna just go without it. We're just gonna talk without any interruptions for all of you. I think it's going to be a more seamless experience. So, okay. All right. 1 more minute to go. Unemployment is out, and we are looking at 4.4% unemployment. Markets are going to be leaning more towards a rate cut in about 20 days. We've got the next meeting, the next Federal Reserve meeting, and the markets are indeed open for business. QQQs are up over 2%. Volatility is down 17. S&P is up over 1.5%. We got Nvidia starting us off with a 4.6% gain back up to 195. And Tesla also up over 2.9 back up to 415 right now. So very, very strong open. The real question is this 50 EMA going to hold up? The worst thing that we could see for this market is yet another lower high. So that's not what I want to see. This is already a couple lower highs. If we get rejected there again, then that would continue this downtrend that we're in. So thank you so much for joining, everyone. Again, link's going to be down below if you're interested in joining. December 1st, mark your calendars, is the date. We are going to be launching our brand new updated version of the MoneyVest platform. So if you want to get access to all the trade alerts, members only videos, portfolio updates, educational courses, and the MoneyVest website, all of that is going to be included there with a 40% discount available. And happy Thanksgiving, happy early Thanksgiving to everyone as well. Thank you so much. Happy investing. I'll see you all in the